Thanks for tuning in to this episode of the Resilient Advisor Show. My name is Jay Coulter, and joining me today for this conversation is Elisabetta Basilico. She promises me that I've pronounced her name correctly, and we are going to go deep on tail risk. Elisabetta is the co-author of the book Smarter Investing. She has a very storied background in academics and practice. So Elisabetta, tell viewers and listeners a little bit about your background.
Yes, hi Jay, it's a pleasure to be here. Yes, we are defined pre-academics, so academics that are at the intersection of the practice. I have a passion for research. So at a certain point, actually after working in the industry at the pension fund, I decided to sign up for a PhD to get my doctorate in research. And then I continue to blend practice and research in my everyday work. So I do research, and then I also try to apply with some clients, asset managers or family offices, what is best in academia. And of course, then, I work with my co-author, Tommi, on a book, and we have a blog where we our mission is really to democratize research, make it accessible and transparent for advisors and investors in general.
Democratizing research. I like that. Your website is very comprehensive and a great tool for folks that really want to go deep on the topics, not only that we talk about here today, but it's a wide range of topics on the website. For audio listeners, it's academicinsightsoninvesting.com, academicinsightsoninvesting.com. If you are watching this broadcast live on LinkedIn, Twitter, Facebook, YouTube, please ask any questions that you have, Elisabetta, as we go through this interview process. If you ask a question while we are broadcasting live, my team will send you a hard copy of my book, The Resilient Advisor, to thank you for your comments. So, Elisabetta, let's get started with tail risk. I want to play a clip. This is from an interview that I did earlier this week with Michael Gayed of the Lead Lag Report. So talk about a period of disconnect, the late 1990s during the tech IPO. I came across the Renaissance IPO ETF, threw it into my Y Charts account, and look at this thing. Does this look like the late 90s to you?
I'll tell you in 3 years. I mean, it's very possible, right? The reality is, look, there's been this unbelievable mania going on, right? And I haven't looked at the constituents of the ETF in a while. I assume there's a lot of tech names that are probably come to market on that, right? Again, manias can be manias for a while. Overbought can stay overbought for a while.
That is tail risk to me. I'm 47 years old. I lived through that internet bubble, had clients have their whole portfolios completely collapse. And of course, that was the first of several that I've seen in my career. Elisabetta, what is tail risk to you?
So to me, the answer of the academic in me is that it's a portfolio move of at least 3 standard deviation from the mean. So the mean of the return, the average return, and it happens more often than a normal distribution would usually tell you. So this is the academic in me. The practitioner in me would say that it's an event that can have a huge negative impact on the portfolio, and again, it's more often than we often think. So it's something that is very important to consider when setting up a portfolio or a planning for investment in the future.
I love the way you're answering the questions through the lens of both the academic, so the nerd in me loves that, and then the practitioner, because quite frankly, that's where most academics get it wrong. The folks in the ivory towers that have never sat down at a kitchen table, kneecap to kneecap with somebody during an event where there's been tail risk, when there's been a massive drawdown and people's lives are turned upside down. Completely different than dealing with an academic lens on it. So let's talk about these 3 standard deviation events. So we look back over the last 30 years. which ones stand out to you the most?
Well, definitely the great financial crisis. And I think that's when the concept of tail risk hedging gained traction. We had, so the great financial crisis went from about October 2007 till February 2009. I was actually working at the pension fund as a practitioner, so I lived that crisis, and I was in quant land, which we had also the quant meltdown, etc. So that is when the concept of tail risk hedging gained traction, as I said. And this is very important to me because I think that what I've noticed through the years in my practical experience is that when do we start to think about tail risk hedging? Usually you start to think about it when there's been a prolonged bull market. You start hearing about it in the bankers or the financial advisors start talking about it in during meetings with clients, and then it becomes very popular though when the crisis already happened,
Right.
and then you start seeing if you have clients like I have some institutional clients, they start receiving pitches about complex structure. And in my opinion, we talk about it in the chapter in the book about tail risk hedging. That's the wrong time when to start to think about it, because ultimately what the research says is that tail risk hedging should be an asset allocation decision. So you need to start thinking about it when you set up your investment policy statement. Mm-hmm. That is the right time, because when the turbulence is already in the market, it's already too late to think about it.
So you sent over a graphic for this interview, and I'm going to throw it up on the screen now for podcast listeners. This is about turbulence being around the corner, and she breaks down bull markets into different periods. I'll have links to it in the show notes. Elisabetta, tell us what we're looking at.
Yeah, so this is an extract from the chapters, the chart that we have there, and it shows the strongest bull market since 1932. So when at the time we were finishing up the book, it was the end of 2018. This chart won't really change if you were at the end of last year, 2019. So we were witnessing the second largest bull market since 1932. And again, I'm an academic, but also I do, I'm a practitioner. I do have some clients that like family offices that I advise. And I, again, started to see some of them telling me, well, what do you think about tail risk hedging solution? But you start to hear about it. And then March of this year, 2020, with the coronavirus hits, there is the turbulence and everybody thinks about implementing complex structure. And as I said, I don't think that's the right time, because when every investor, every advisor, in my opinion, should start to think about implementing a tail risk hedging strategy when they're setting up the investment policy statement. And as you see in this visual, I have three that I think are very important to ask for an investor when setting up the investment policy statement. What is the portfolio exposure to tail risk? Clearly, if you have equities in your portfolio, you do have exposure to tail risk. What are the trade-offs when setting up protection? Because the trade-offs are two. The level of protection that a solution gives to the portfolio and the cost, which translates into negative impact to the expected future return, because the solution has a cost. And then the third question is it better a direct or indirect hedge? In specifically, this third question is something that we delve deeper into the chapter of the book, bringing up, as I said, what does the science say in terms of which solution are best to implement for tail risk hedging?
Okay. So I want to get into the book. We also have a question from Matt Underwood that I want to pose to you. But before we move on to that, I want to stay on this concept, and I want to break it down for the financial advisor. I understand what you've said twice now, that when you create the investment policy statement, that's when you should start accounting for tail risk. That's just not the reality for a lot of financial advisors dealing with retail clients, even in the $2 to $5 million space. So based on your experience, if you're an advisor today and you're dealing with that marketplace, how do you go and implement it today at the end of 2020, given what we've seen in the market this year?
Well, I think that there are some, how can I say, like common question that an advisor should ask the client that are evergreen, and they revolve around the tolerance to the risk. Like we have actually another chapter in the book where we also talk about this more specifically in terms of understanding the true risk that the client can withstand both emotionally and practically. If your portfolio gives you allows you to have a certain lifestyle, so you need to be careful about how you implement the asset allocation of the portfolio. So you need to ask your client how much risk they can tolerate emotionally and psychologically. So if I were to start today, I would start from there. I know that we have had ups and downs in the markets, but the question of where how much risk to have in a portfolio should be asked at any point in time, in terms of once you figured out how much risk your client wants in the portfolio, then you should first allocate to equities that an amount to equity that is in line with the drawdown that this investor can withstand, is again emotionally and practically. I know it's not easy, but I insist a lot on this because I think it's a suggestion.
Excellent. And Elisabetta, I got to tell you, you're doing a great job with English not being your primary language. Let me reframe that last question. If I'm a financial advisor and I have a client with a $2 million portfolio and they are your typical 60-40 risk tolerance, 60% to equities, 40% to fixed income, they don't have necessarily an investment policy statement, but they want to go hedge against that tail risk. What should they be considering today?
So, as we were talking a little earlier, there are two possible solutions: the direct hedges and the indirect hedges. The direct hedges are the solution that revolve around derivatives like puts or collars. And then there are indirect, like substitute a component of that 60% of the equities with low beta stocks, for instance. That's one possibility. Or implement a risk parity solution, or implement a portion of the portfolio with trend following solutions. So the research, there is a number of papers that have dig deeper into which solutions are best. And the answer in briefly of the majority of the research that we looked at and that we think is quality research points to the indirect solution. So again, substituting equities with lower volatility, or trend following is also something that's robust and is has a good trade-off between those two that we were mentioning at the beginning: efficacy in protecting the portfolio and costs. Because unfortunately, while the direct hedges, like the derivative structure, seem to protect the portfolio during the worst event, like that, if there is a day or a month where you have the majority of the drawdown, you have to be perfect in timing when you put on and put off the solution. Otherwise, the returns will suffer over a prolonged period of time. So in other words, direct hedges, which are the most common, proposed by the bankers, the advisor, the investment banks, are not the best solution.
So to unpack that just a little bit, because I think there's some gold in there. If you are worried about putting on some hedges and you are running a wealth management practice, the option strategies are probably not that viable unless you're using a covered call ETF like Devo or something along those lines. What you're suggesting is lower the beta of the portfolio, which could easily be done with ETFs, looking at some risk parity solutions added to that 60-40 mix, Or one of my favorites, look at adding some trend following models into your portfolio to hedge the risk. Is that a good summary of what you suggested?
Great summary.
Awesome. All right. We've got a question from Matt Underwood. I'm going to throw it up on the screen and then read it for audio listeners. How do we hedge ex ante expectations of tail risk plus or minus 3 sigma with a fairly significant amount in private market assets where unsmoothing using autoregressive models still understated high momentum risk? It's clearly a question for you, Elisabetta. I can barely read it. Is there a holistic framework to hedge where individual components may have varying liquidity profiles?
It's a great question. And of course, when you have private market exposure, things become a little more difficult for the exact same reason that he was mentioning, this autoregressive, which is a statistical term to say that you don't feel the pain immediately because the net asset values are not daily, or they're not even monthly. Sometimes impact to the portfolio when the turbulence has passed. And so in terms of there's the simple answer is that there isn't really a framework other than you should try to, one suggestion that I would give is I use the small caps to proxy private equity to actually get a more realistic picture of the risk that you have in the portfolio, and then kind of implement the edge based on how much you want to lower down the risk. That's one possibility. And then, well, the other way to think about it, at the same time, if you have an investor that panics a lot, maybe having private markets will help the portfolio in terms of not selling at the wrong time. But of course, if you want to be precise with hedging the risk, you need to use proxies.
Excellent. And again, great job with English not being your first language explaining it. I could barely read the question. You had to answer it in a language that isn't even your first. Let's transition over. And Matt, thank you for that question. Let's talk about your book, Smarter Investing. Walk listeners and viewers through the constructs of the book, why you and your partner Tommi wrote it, and what it's about.
So yes, as I was mentioning, Tommi and I, Tommi was my professor of markets when I was doing my master's in the United States. And we have then collaborated through the years. At some point in time, we decided to join forces to translate our passion for research into something tangible. So we wanted to find a way to, as I said, democratize research, make it accessible, transparent, usable, because of course, academic research oftentimes is written for the academic and not for the practitioner, not for the advisor. We recognize that there is so much in the academic world, so many papers published that advisors don't have the time and oftentimes need to read these papers. But there's gold in them, in many of them, the quality research, there's some very great insights. So we started with the book, the idea of writing. We have about 10 topics that we think are important, because they're popular, because we think that they're important to be in a portfolio. And we delve deeper. We curated the literature to find the best representative paper, both for the topic and also a paper that would be quality, econometrically sound, robust. We have a checklist that we go through when we curate the literature to find the best paper. So every chapter has a topic, like tail risk hedging. We identify one paper, we break it down in simple terms, in terms of what are the research questions, what are the academic insights, Then we give some practical solution. And we wrote it with the financial advisor and the curious investor in mind, mainly.
Meaning,
and then we have a blog.
Meaning folks like me can understand it.
Yeah. And then we have a blog also that is a continuation of the book. Every week we publish one paper that we think it's important to read and understand, and we break it down in section like research question. What are the main insights? We post the most important chart of the paper that we think someone who has little time to read should pay attention to.
All right, so 10 topics. We spoke about tail risk here today. What are, and let's not run through all 10, what are your 3 favorite topics in the book?
Another one is definitely what the chapter that we call multi-asset investing is about asset allocation and the importance of measuring risk the right way when you build an asset allocation for a client. That is, I think, one of my favorite. And then we have also one on ESG that I think it's pretty interesting for the time being that we cover. And then others like factor investing, index investing. But
okay,
my favorite would be ESG, tail risk hedging, and multi-asset investing.
Let's talk about ESG investing. And you did not know I was going to ask these questions because I didn't know you were going to bring ESG up, but it's top of mind for me. I'm doing some research for a client. We're building out an ESG model for their firm that can be one of their staple portfolios. And I'm trying to essentially capture beta, but then have the ESG parameters that we are able to acquire from some indexes that are in the marketplace. They all own the same stocks. They've all been driven by these big tech performers, and that attribution, has been great on the upside, but is going to be very painful on the downside should they not change. If you were a financial advisor today, Elisabetta, and you wanted to build an ESG solution for your clients, what approach would you take?
Well, I think and we talk a little bit in the book. I think the main issue with the ESG investing is that right now is the data. So you need to make sure that you have a good data infrastructure to correctly select the right stocks. There is a little bit of confusion of what ESG is and whether ESG adds value to the portfolio. But it all boils down to the framework that you have, the quantitative framework that you're using to select stocks. So, definitely there is research to be done in terms of like what provider you use to select the portfolio, I think.
Mm-hmm. Well,
so it's a complex, it's not an easy, it's pretty complex, I think, matter. But we hope that we will go in the direction of standardization in terms of like databases so that it'll be easier to build portfolios.
Mm-hmm. Yeah, there has to be some standardization. It's too much of the Wild West. And like I said, these larger indexes or ETFs that follow these indexes own so many of the same securities. Another mandate from another client of mine is to find a small cap ESG ETF. And you would think that would be pretty simple to do. I mean, there's a couple out there that haven't been around that long, but it would seem just the whole construct of taking a small cap company, putting on an ESG filter and building a portfolio that can hopefully deliver the beta of what they're trying to capture, is going to be a bit of a challenge. Do you have any thoughts on that particular part of the ESG space, small caps?
Not at the moment. I would have to do a little more, obviously I would have to do a little research. But again, I think the main advice is to, and I don't know how you go about it, but one thing that we found is that depending, ESG could be started as being eliminating the negative, some negative attributes of stocks, and then it turn into more selecting the positive, right, factors. Mm-hmm. And research seemed to say, for instance, that the positive is where you add value rather than eliminating the negative. So if you're looking at single stock, again, I think you need to have a strong infrastructure. If you're looking at ETFs, I would have to dig deeper into the methodology that they use. This is similar to another topic that we have researched more, which is factor investing. You know, when I was looking at ETFs, I struggled to find the true product that would have a strong tilt towards value or momentum. And I think it's the same with ESG. And when you delve deeper into the methodology, you kind of figure out why. You know, it depends on which indicator they're using. So if you're doing value, are you know, how are they constructing the portfolio? There's so many indicators that could be used to select value. And, you know, how much, you know, how are they constructing the portfolio? Are they, you know, are they being very active? Like, you know, are they introducing active risk, selecting few stocks, or is it more like a closet indexer? So again, for ESG, I would have to do a little more research, but I would think that it's the same problem in terms of, like, answering your question, that you're finding difficulties and they all look the same. It's because of how they construct the portfolio.
Okay, excellent. Well, Elisabetta, I really appreciate you coming on the show. Listeners, if you would like to pick up a copy of Smarter Investing, I've posted a link on the social media platforms. I will have a link inside of the show notes, and you can also go to academicinsightsoninvesting.com. Elisabetta, thanks for coming on.
Thank you. Pleasure.